Cloudcast Media presents from the massive studios in Raleigh, North Carolina. This is the Cloudcast with Aaron Delp and Brian Gracely, bringing you the best of cloud computing from around the world.
Good morning, good evening, wherever you are, and welcome back to the Cloudcast. We are coming to you live from the massive Cloudcast studios here in Raleigh, North Carolina. Hope everybody is doing well as we move into the beginning of August 2021. Can't believe it's August already. Another Sunday perspective show, and we're going to dig into a topic that we covered a little bit in a Cloud News of the Week a couple of weeks ago. It's just sort of a bullet point, kind of what felt at the time like a little bit of a throwaway. The more I think about it, I think it's an interesting topic to dig into a little bit, because one of the things that we always like to do on this show is, one, we like to go find new technology, but number two, we always have this sort of mindset of it's really important to follow the money and figure out where money's flowing in this industry. It helps you kind of figure out certain trends, whether trends are good or bad or other types of things. But follow the money is always sort of a good way to figure out where people are betting their wallet as much as their hearts and minds in technology. So I thought what we'd do today, there was an article that we mentioned in Cloud News of the Week, like I said, a couple of weeks ago. It'll be in the show notes as well. That talked about VC funding being up, number one, being up significantly for 2021, but also being up significantly, even more so in Q2 of 2021. So the April to June timeframe. And I thought what we would do is kind of dive in a little bit as to why we're starting to see this, bigger trend of more money, not only more money as an aggregate piling into the market, into startups and investments, but also the amount into individual companies, sort of, very large A rounds, very large B rounds, those types of things. Why are those things happening? And, if you followed the show for a long time, we've always sort of kind of followed who gets invested in, what their life cycle is. We try and track some of those things. We've had a fairly good track record of finding some of those companies and, watching their life cycle evolve. But I think it's kind of important to see, is this something that's, reshaping the industry? Is there a specific reason why this is happening? And so we're going to dig into all those things right after the break. Today's show is brought to you by CBT Nuggets. You know how much we value ongoing education on the Cloudcast, and CBT Nuggets is exactly what Aaron and I wish we had when we were trying to get our certification early in our careers. CBT Nuggets is all about bringing a personalized touch to learning about cloud computing, virtualization, networking, DevOps, and much, much more. Whether it's their hands-on labs with personalized coaching, or the online chat functions that come up with every instructor-led course, CBT Nuggets' team of experts is always there to help you get the most from your training and your path to certification. You can check it all out at cbtnuggets.com/cloudcast and sign up for a free trial. You get access to the full catalog of great training, including virtual labs, quizzes, and other premium features completely free for the first 7 days. That's cbtnuggets.com/cloudcast. Today's show is sponsored by Datadog. Now with cloud security posture management, Datadog allows you to see compliance scores across your infrastructure and track conformance to industry benchmarks such as CIS and other regulatory standards, out-of-the-box cloud and infrastructure configuration rules. Datadog Cloud Security Posture Management, CSPM, performs configuration audits across cloud accounts, hosts, and containers. As a special offer for Cloudcast listeners, you can sign up for a free 2-week trial to see for yourself how Datadog can elevate your cloud infrastructure security posture by going to datadog.com/security-cloudcast. That's datadog.com/security-cloudcast. Sign up now and receive a free Datadog t-shirt. And we're back. And as I mentioned in the top of the show, we're going to look a little bit at why we're seeing so much funding from the VCs in our industry, maybe more so than we normally do. Obviously, if you've followed the show for a while, you know that we sort of track that. There's always been money flowing into innovation, into this industry, into the tech industry as a whole. But we're starting to see this sort of blip. Actually, not even maybe a blip, sort of a spike, if you will. And I thought it would be sort of interesting to dive into some of the reasons why this might be happening. We obviously can't get into the minds and the spreadsheets of every VC, but having covered this for a while, I think there's some things that are going on that are worth looking at as maybe just sort of standard fare, but also there's some things that have changed in the industry that are worth kind of digging into. So let's start with sort of the basics. Anytime we're seeing, very, very low interest rates, and we're seeing low interest rates around the world, and for the most part, other than a few places, just recently, inflation has been fairly low. So we're seeing very low, very, very low interest rates, nearly zero in many places, in some countries negative. And so anytime VCs have access to essentially free money for the most part, we're going to see them making more and more investments. And keep in mind, VC is sort of a very interesting way of investing. It's in essence very limited downside. So they're only limited on the downside of what they invest into a company, and potentially unlimited upside. So it's a very interesting, essentially gambling model, if you will, investment model, whatever you want to call it. But when you can get access to sources of money that are incredibly low, whether they're taking it out, whether they're getting from investors or whatever, but when the global sort of way of getting access to money is very, very low, we tend to see more and more investments. That's not necessarily totally new, but we have seen very, very low interest rates for the last number of years, especially over maybe the last 3 or 4 years, especially. We are seeing, kind of secondhand orders of the pandemic. So the pandemic obviously dominated the news in 2020. We saw governments pumping tons and tons of stimulus money into the economy. In many cases, that money didn't have to get paid back. So essentially free loans, if you will. And we've seen, a lot of that happening, especially over the last 12, 15 months or so. So a lot of not only cheap money, but a lot of money flowing from governments that was made available or became sloshing around in the global economy. And so, that money goes searching for bigger and bigger returns because you can't put it into safe havens because the interest rates are very, very low. Now, the third thing I think is worth noting is, we're about a decade or so into sort of the cloud computing reality, right? If you go back at some of the shows we've done on Sundays, or if you've watched the show for the last decade plus, we're now into a full decade cycle of cloud computing. We're seeing all three of the major cloud providers and even the fourth and fifth cloud providers continuing to have very good earning numbers. We'll actually cover the earning numbers in the Wednesday show coming up next week, so stay tuned for those. But we've been through a decade of that. And if you think about that, most enterprise IT, startups are a little different. Obviously, startups come and go, but enterprise IT, tends to run in between 3, 5, and 7 year refresh cycles. So whether it's, compute being maybe a 3-year refresh cycle, storage being maybe a 5-year refresh cycle, networking being maybe a 7-year refresh cycle, we've now lived through one of those. And no matter where companies got involved with the cloud, they're now into their second stage of that. And what that means is, while we're always sort of trying to figure out, will the cloud grow forever? Okay, we know that won't happen necessarily, at least maybe not in the exact same format it is today. But in terms of sort of the mass, the gravity of the cloud, you tend to, once you get into, being invested in a vendor, in an environment, in an ecosystem, you tend to stay there, right? It tends to be more work to move. So, we've kind of, I think, can feel fairly comfortable that the big 3, 4, 5 are going to be fairly entrenched because we've already now lived through that first decade. We've lived through, what's going to be coming up, if not already once, a second time refresh cycles for people in terms of their budget. And, we're not buying hardware anymore, but just in terms of the way they budget, kind of going through those cycles is starting to play itself out. So, we're seeing massive amounts of capital going into the public cloud and OpEx and CapEx and so forth. And so, more and more things are going to consolidate around the IT industry. And when things consolidate around the IT industry, to a certain extent, you do see more and more investment happen around the edges, trying to bounce, find places to make money, but also you see people figuring out, can we compete, right? Are there things that we just shouldn't try and compete on in certain spaces? So, the gravity of the big 3 tech is definitely shifting how people think about their investment, about where they think about innovation potentially happening, and so forth. So the third thing or fourth thing I've got on the list is there really is no more middle ground. We used to always have sort of middle ground in the tech industry. You had, certain leaders, maybe you had an Oracle or a Cisco or, Dell or somebody like that, an EMC or a VMware. And then you had, smaller players. You had really, really little niche startups. If you ever went in the back of a trade show, along the back wall, there was always, the ones who had a 2x2 booth and you had no idea what they did. But there was always a really big, robust middle ground. And just like we've seen a lot of industries, the middle of the tech industry is kind of getting hollowed out, right? We're seeing more and more around innovation, and we're seeing more and more around kind of the big 4, 5, 6 cloud providers and some companies around that. So, that's another thing that sort of drives more and more investment around these startups, right? You can't necessarily just be, a startup that's going to have $100 million exit or a $200 million exit or something, right? In order for it to make an impact, either strategically or competitively against the bigger side of the equation, it's got to be, a billion-dollar type of thing, multi-billion-dollar type of thing, whether it's going to get acquired by one of those companies or whether it's going to, have a distinct impact in those companies. So in order to do that, we're seeing more and more investment in order to accelerate how fast those companies can grow, accelerate their ability once they gain some traction in a market to help them grow and to foster bigger market and so forth. So I think we're seeing that as well. We're seeing a hollowing out of the middle of the tech industry over the last decade plus. And again, it's because we've seen things happening in the cloud industry. We've seen things like open source, eroding some of the proprietary types of technologies and so forth. The third thing is, or third, fifth, sixth, whatever number we're on at this point is, the cloud providers, have been sort of mixed bag in terms of acquisitions. In the past, the largest companies would swallow up a lot of them. We sort of see sort of a mixed bag in terms of cloud acquisitions. So, I mentioned, I think on the Microsoft show a couple of weeks ago, they've done 85 plus acquisitions since Satya Nadella came on board. Google has done a few, GCP has done a few, AWS has done a few, but not necessarily as much. So, in order to be able to change their world, in order to be able to change their direction, if you will, you've got to be fairly large. You've got to be, $500 million and above, right? And not just in valuation, but driving those sort of revenues. Because when you start getting into companies being worth 20, 40, 50, 60, $100 billion, unless you're more than $1 billion, you're really not moving the needle for them. And it may not necessarily be worth their time. So, as startups are coming along, as VCs are trying to make them, potentially interesting acquisition targets, they've got to be pretty big and they've got to be fairly large. The next one I have on my list is just kind of our state of mind, our state of, willingness to look at 4 and 5 and 6 alternatives. People don't tend to have time for that anymore. They tend to sort of find which one's best. We tend to see, the thing within a certain industry sort of take off. And, I think the VCs are basically sort of saying, hey, maybe in that B round, we're going to invest what would have been a C round or a D round to try and accelerate that. Because if we see ourselves having that early market lead, the more fuel we can pour on the fire, the more we can sort of gain that immediate attention for people. We gain the buzz around it. We gain all the social credibility. And then obviously we sort of, capture much more of the early adopter. And once you've done that, it becomes much more difficult for anybody else to become a third, fourth, fifth player in the industry because people just don't have time to evaluate it. People like CIOs are only staying in roles for a couple of years. Most people are only staying in certain roles for a couple of years. So if you're not getting out in front, influencing those people within the early parts of their job before they leave and go take on some other challenge, it becomes harder and harder. So, the VCs pumping more money in to try and accelerate that is yet another thing. Next thing I had on my list was, we're no longer kind of dealing with kind of core technology problems anymore. Compute, storage, networking, bandwidth. There's still things that address those things. They get incrementally better, but we're now dealing with some stuff that's really, really big in scope, right? Things like AI and ML, right? Massive amounts of data, massive amounts of compute to be able to deal with that. We're dealing with, autonomous driving, self-driving vehicles. We're dealing with, genetic testings to accelerate vaccines and pharmaceuticals. We're dealing with, scale of 5G to, millions and millions of end users. We're dealing with energy discovery and optimization. We're dealing with, everything delivered, right? So all these sort of problems that we're now dealing with, the underlying technologies of them are really big in scale. And they're not things that, a $10 million investment, a $20 million investment can necessarily move the needle. Maybe it needs to be $100 million. Maybe it needs to be $200 million. And so, I think that's another reason is to be able to, again, make an impact on these really big scale technologies. They need a significant amount of funding, not only in their ability to, use large amounts of compute and data, but also, the price tag on some of these really, really high-end skill sets, whether they're in AI and ML or specific sorts of metals and sciences and so forth, is very, very costly. So again, the price tags have gone up, the scale of the problems have gone up, and I think that's another reason we're starting to see more and more investments is that people, secondarily don't want to be investing in things that could be third, fourth, fifth best in their category. Next thing I had on the list is, obviously investing is one side of it. Being able to get the rewards of that is the other side of it. And if we look at over the last couple of years, and again, this is sort of cyclical. I don't know if this is something that will necessarily trend forever, but if you look at the last 5 years, you look at the last 10 years of the S&P 500, the NASDAQ, some of the major markets, they are heavily overweighted by tech stocks. 10 years ago, 15 years ago, the largest companies in the world were oil and petrochemical and banking, and we've seen some other things. Right now, tech is king. And, the largest companies in the world, the largest valuations in the world are tech companies. And so again, VCs recognize that, the valuation put against those may be overblown, but, they want to kind of get involved with them, when the market is, is paying premiums for those types of things. So again, throwing money at trying to accelerate the speed at which you're able to get those returns and get that market adoption or that market perception of high valuations. And then I think the last thing I'll talk about, and I'll kind of wrap it up, is I think, especially as I've started studying more and more like SaaS type of models. And obviously, if we look at where the spend is in cloud computing, SaaS is the biggest one. Now it's a highly, highly fragmented market. There are thousands of SaaS companies as opposed to quote unquote the big three clouds and so forth. But I think as you study more and more of the SaaS models, those businesses, maybe more so, and this is always the striking thing to me as I sort of study the SaaS businesses, they become much more formulaic in terms of what their go-to-market, what their sales, cost of marketing, how they can pinpoint and target marketing campaigns, how they can target customers, how they can manage retention, how they can manage onboarding. All those things are much, much more well-defined in the SaaS space because everything's online, everything has telemetry behind it. There are so many advanced tools to be able to do sales marketing, inside sales, track customers through cookies as they trial things out, all that sort of stuff. More so than we've ever seen where we had enterprise, playing golf, having steaks, drinking bourbon kind of sales forces, and the technologies associated with them, software centric as opposed to cloud centric. So, I think as we better understand maybe not necessarily how to invent the next idea, but how to run the company once a good idea happens. We're able to accelerate those things, and as they become more formulaic and more better understood, the risk you have in investing in those kind of companies becomes less, and you might be willing to invest more and more money into that. So, I think as I think about this overall space, I'm going to kind of wrap it up a little bit. I think those are probably the top 6, 7, 8, 9 reasons. I think that we're seeing again this doubling down on investment. Now, caveat emptor, please don't take any of this as investment advice. We very well may be, at the end or coming near the end of a bubble. The other thing we see at the end of bubbles, if we happen to be in a tech bubble, and again, I don't know whether we are or not, is sometimes we see people getting overly enthusiastic. We see things being highly overvalued and people pumping a lot of money in thinking, well, I missed the early wave of this. I'm going to get money in at the end. I'll be able to make the same sort of returns. That might be what's happening as well. So, there might be, as I talked about for the first 10, 15 minutes of this segment, lots of good rational reasons and sort of market forces changing reasons. But we also may be seeing, the beginning of a bubble, and we've seen those in technology before. We saw that in 2000. We saw that a little bit in 2008, and maybe we're beginning to see some of that here with the massive valuations that we're seeing in tech. So caveat emptor, keep your eyes open, be smart about as you think about, how you invest your money. But, as I was thinking about why the VCs are investing so much money, that was sort of the list that came to mind for me. And I think, we'll see how it plays out. We'll see whether or not, tech continues to have this huge run that it does. I think those of us that live in the tech industry tend to think it will, but, it's always good to sort of analyze why we're seeing money flows, follow the money, track why it might be happening. And then, as things evolve over time, whether it's interest rates or, global geopolitical winds changing or just, the competitive dynamics of the market, go back and reevaluate it from time to time. So with that, I'm going to wrap it up. Thanks for listening to today's Sunday Perspective. Thanks for telling a friend about the show. Thanks for helping us grow the community. And we will talk to you next week.
Thank you for listening to The Cloudcast. Please visit thecloudcast.net to find more shows, show notes, videos, and everything social media.